In the midst of the Second Global Conflict in July of 1944, while American ground forces were breaching the shores of Normandy and United States Marines were engaged in fierce battles across the islands of the Pacific, a significant assembly of 730 representatives from 44 different nations convened at the Mount Washington Hotel, nestled within the scenic mountains of New Hampshire. The raging World War II offered no clear indication of its conclusion. Nevertheless, the influential figures of the financial world had already shifted their focus beyond the ongoing hostilities to meticulously plan for the subsequent era. For a period of 3 weeks, within the opulent surroundings of this luxury resort, situated far from the grim realities of the front lines, these individuals set out to redefine the very structure of international finance, establishing a framework whose influence continues to shape your current economic circumstances. The outcome of these deliberations was not primarily aimed at averting another widespread economic depression, despite the prevailing narrative you've likely encountered. Instead, the Bretton Woods Conference gave rise to something far more profound, enduring institutional structures that vested central banks with oversight of global monetary flows, operating beyond the reach of democratic political processes. This included the establishment of the International Monetary Fund and the World Bank, alongside the dollar-gold system, which remained in effect until 1971. These instruments were conceived to address a persistent challenge that central bankers had grappled with since the 1920s. While they possessed the capacity to influence monetary conditions within their own national borders, international currency movements consistently eluded their complete command. The recurring pattern you're about to uncover illustrates how each major financial upheaval has served as an opportune moment to consolidate monetary authority. Bretton Woods represented the refinement of this strategic approach. Gaining a thorough understanding of the events that transpired in that New Hampshire establishment 80 years ago provides you with the essential insight needed to interpret any proposal for international monetary reform that arises today. The narrative truly begins not in 1944, but within the period of profound instability that central bankers found themselves unable to control. Prior to the outbreak of the First World War, the established gold standard imposed a form of discipline, limiting the actions governments and their central banks could undertake. Nations maintained fixed exchange rates through the convertibility of their currencies into gold, a mechanism that prevented the unfettered printing of money without significant repercussions. However, the Great War altered this landscape drastically, compelling every major nation to suspend gold convertibility in order to finance their wartime expenditures. Their intention was to reinstate the gold standard once the conflict concluded, yet they made a critical miscalculation. They opted for incorrect exchange rates. In the mid-1920s, Great Britain made the decision to revert to the gold standard at its pre-war parity. This occurred despite the fact that substantial inflation during the war had fundamentally reshaped economic realities. Winston Churchill, serving as Chancellor of the Exchequer, made this choice, disregarding the cautionary advice offered by economists such as John Maynard Keynes. The predictable consequence was a devastating deflationary pressure that severely impacted British industry and worker compensation. Concurrently, France rejoined the gold standard at a devalued rate, bestowing upon French exporters a competitive advantage that Great Britain had just relinquished. The Bank of England found itself in a precarious position, unable to stimulate its domestic economy without risking the depletion of its gold reserves to France and the United States. The onset of the Great Depression escalated these inherent tensions into open currency warfare. When Great Britain ultimately abandoned the gold standard in September of 1931, the pound experienced an immediate devaluation of 30%. The United States followed suit in 1933, devaluing the dollar by 41% against gold when President Roosevelt increased the official price of gold to $35 per ounce. France, meanwhile, persevered until 1936, witnessing its economy suffer severe damage as it defended a gold parity that had become untenable. Each nation attempted to export its unemployment to trading partners through competitive devaluations, fragmenting international commerce into adversarial monetary blocks. The sterling area, the dollar area, and the gold bloc. Central bankers were confronted with a fundamental dilemma that no amount of technical proficiency could resolve. They could regulate their domestic money supply, but cross-border gold movements consistently undermined their policies. The Bank of England was prevented from halting gold outflows without raising interest rates, which would have crippled the already struggling British economy. The Federal Reserve could not pursue expansionary policies without risking the loss of gold reserves. Each central bank prioritized its narrow national interests, and the collective outcome was widespread chaos. Yet from this disorder emerged something that would prove to be more consequential than the disorder itself. In 1930, governments established the Bank for International Settlements, ostensibly to manage German reparation payments stemming from the First World War. The stated purpose held little true significance. What mattered was that it provided central bankers with a venue for meetings shielded from political oversight. Every month, central bank governors would convene in Basel, Switzerland, for coordination sessions that their own governments scarcely comprehended. These men, and it was exclusively men, discovered a crucial insight. They found it preferable to coordinate amongst themselves rather than be accountable to politicians or parliamentary bodies. The Bank for International Settlements established a precedent that Bretton Woods would perfect 15 years later. The strategy involved identifying a crisis, such as German reparations, and utilizing it as justification for the creation of a permanent institution operating outside the purview of democratic accountability. This was cloaked in technical language designed to exclude non-experts from meaningful involvement. Subsequently, this institution would outlast the original crisis and expand its influence into new domains. The Bank for International Settlements continues to operate today from the same Basel Tower, now orchestrating central bank policies for the global economy. By 1941, even before Japan's attack on Pearl Harbor drew the United States into the Second World War, central bankers and their allies in finance ministries had already recognized the forthcoming opportunity. The war would devastate Europe and Asia, creating conditions where beleaguered nations would be compelled to accept any monetary system that offered reconstruction assistance. Two individuals positioned themselves to architect this system: Harry Dexter White, representing the United States Treasury, and John Maynard Keynes, acting on behalf of Great Britain. White had commenced planning America's post-war monetary architecture as early as 1941, formulating proposals that would place the dollar at the very core of international finance. His vision was extraordinarily ambitious, envisioning an international monetary fund capable of enforcing exchange rate discipline on a global scale, and a World Bank tasked with channeling reconstruction loans in a manner that fostered perpetual dollar dependency. What White grasped, and what most individuals fail to comprehend even today, is that whoever controls the international monetary system exerts influence over far more than just exchange rates. They control capital flows, the terms of trade, and ultimately the economic sovereignty of every nation involved. Keynes entered these negotiations with his own distinct plan, one that aimed to prevent any single nation from dominating the system. His proposal centered on an international currency, to be named Bancor, managed by an international clearing union operating independently of any national government's control. The Keynes plan incorporated automatic penalties for countries experiencing either deficits or surpluses, thereby averting the kind of global imbalances that had destabilized the 1930s. Most significantly, it would have necessitated that even nations with surplus balances, including the United States, adjust their policies when imbalances arose. However, Keynes was negotiating from a position of weakness, while White held all the leverage. By 1944, the United States commanded approximately two-thirds of the world's monetary gold reserves. European nations faced economic devastation that would require decades to rectify, leaving them desperate for American capital. Great Britain itself was bankrupt, subsisting solely on American lend-lease aid, which could be withdrawn at any moment. When you control the gold, and your potential partners are facing financial ruin, technical economic arguments take a back seat to raw power. The fundamental principle of might makes right operated in its purest form. Whoever possesses the gold dictates the rules. White and Keynes engaged in private negotiations throughout 1942 and 1943, meticulously crafting the foundational framework that would be presented to the other participating nations. This was not an open, multilateral diplomatic process. Rather, it was a bilateral negotiation between the world's two preeminent financial powers, with the stronger partner dictating the terms. By the time the Bretton Woods Conference convened in July of 1944, the major decisions had already been finalized. The 730 delegates from 44 nations were largely present to formally ratify these predetermined outcomes. A system conceived in private by American and British officials. The public structure that emerged conveyed an image of international cooperation, yet the underlying framework told a different story. The dollar became the sole currency convertible into gold, and then only for foreign central banks, not for private citizens. Other nations were required to maintain dollar reserves to support their currency pegs, thereby creating a structural demand for American dollars irrespective of fundamental economic realities. When the United States experienced balance of payments deficits, the rest of the world absorbed these excess dollars as essential reserves. When America needed to adjust its domestic policies, it could disregard international constraints because the global community required dollars more urgently than America needed foreign currencies. The International Monetary Fund was granted authority to oversee exchange rates and provide short-term liquidity, but its voting power was proportional to economic strength. Consequently, the United States effectively held veto power over any significant decision, while smaller nations found themselves subjected to policy conditions whenever they sought assistance. The World Bank established a complementary system of influence through reconstruction lending, mandating that borrowing countries utilize American contractors and equipment while undertaking infrastructure projects that deepened their integration into the dollar-based trading system. Most crucially, both institutions operated through a veneer of technical expertise that effectively excluded democratic oversight from member countries. Complex economic analyses dictated lending conditions, exchange rate adjustments, and policy mandates. National parliaments could debate the outcomes, but the pivotal decisions were made by credentialed experts within international bodies beyond the reach of voters. What appeared to be multilateral collaboration was, in reality, the institutionalization of American monetary dominance, artfully disguised in the language of international technical management. The brilliance of the Bretton Woods system lay not in its resolution of the 1930s problems, which it ultimately did not achieve, and which eventually led to new challenges that caused the system's demise. Its genius resided in its creation of enduring institutional infrastructure that would outlast the specific monetary arrangements. The International Monetary Fund, the World Bank, the mechanisms for coordination, and the precedent for supranational economic management, all of these survived the collapse of the dollar-gold peg in 1971 and continue to function today. The Bretton Woods system became operational in 1945, with the devastated economies of Europe serving as the perfect testing ground for its control mechanisms. The dollar shortage that afflicted war-torn nations was not an accidental consequence. It was an engineered scarcity that bestowed upon the United States unprecedented leverage over the economic policies of sovereign states. Britain's humiliating experience in 1947 starkly illustrated the practical application of this leverage. The British had secured a substantial loan from the United States in 1946, contingent upon making the pound convertible for current account transactions by July of 1947. Within a mere 5 weeks of implementing convertibility, Britain encountered such massive capital flight that its reserves were rapidly depleted, forcing the government to suspend convertibility once again. The lesson was unequivocal. Even the world's second-largest economy could not sustain currency convertibility without American consent and support. If Great Britain could not challenge the dollar system, no other nation could either. The true purpose of the International Monetary Fund revealed itself not in fostering exchange rate stability, but in enforcing policy conditions that transferred sovereignty from national governments to international technocrats. Countries seeking currency support were compelled to accept what became known as conditionality, policy requirements that typically involved austerity measures such as reducing government spending, increasing interest rates, and devaluing currencies to curb imports. Social programs were curtailed, wages were suppressed, and unemployment was tolerated, all in the pursuit of maintaining currency pegs within a system that these nations had never truly chosen. This represented a fundamental erosion of democratic authority. Monetary policy, which impacts every facet of domestic economic life, was increasingly dictated not by national political discourse, but by the demands of international coordination. Central banks found themselves more beholden to the International Monetary Fund and the Bank for International Settlements than to their own legislative bodies. Changes in exchange rates exceeding 10% necessitated approval from the International Monetary Fund, granting foreign technocrats effective veto power over national economic strategies. Meanwhile, the United States enjoyed what French Finance Minister Valéry Giscard d'Estaing would later term the exorbitant privilege of being the reserve currency nation. American corporations could acquire foreign assets using dollars that the Federal Reserve could generate at will. The remainder of the world accumulated these dollars as necessary reserves, effectively financing American deficits with real goods and services in exchange for mere paper claims. When other nations voiced complaints about American policies, Washington could simply disregard them, as the global economy required dollars more than America needed foreign cooperation. By the 1960s, this arrangement necessitated increasingly desperate measures to maintain its credibility. Dollar liabilities held by foreign central banks surpassed America's gold reserves, rendering the $35 gold price mathematically unsustainable. Rather than adjusting policies to restore equilibrium, the major central banks established the gold pool in 1961, coordinating gold sales to suppress the market price and preserve the illusion of dollar-gold convertibility. The gold pool comprised Great Britain, France, Germany, Italy, Belgium, the Netherlands, and Switzerland, all collaborating to defend an exchange rate that primarily served American interests. When speculators ultimately overwhelmed the pool in 1968, forcing its dissolution, the central banks implemented a two-tiered system: an official gold price for central bank transactions and a separate market price for all other participants. The system persevered through increasingly overt manipulation, revealing that technical management was, in fact, political control masquerading as economic expertise. Then came the Nixon shock on August 15, 1971. On a Sunday evening, with global markets closed and without prior consultation with allies, President Nixon announced the temporary suspension of dollar convertibility into gold. Simultaneously, he imposed domestic wage and price controls and a 10% surcharge on imports, compelling trading partners to choose between accepting a purely fiat dollar or losing access to American markets. The Smithsonian Agreement in December of 1971 attempted to salvage the system through wider fluctuation bands and dollar devaluation, with Nixon proclaiming it the most significant monetary agreement in world history. It collapsed within 14 months. By March of 1973, major currencies were floating freely, and the Bretton Woods system was officially defunct. However, here's what nearly everyone overlooks regarding the collapse of Bretton Woods. It did not diminish the control central banks exercised over international monetary affairs. Instead, it intensified that control by rendering it less visible and more adaptable. The era of floating exchange rates, commencing in 1973, was purportedly a complete departure from Bretton Woods. Yet, the reality unveils something far more revealing about the true mechanics of monetary control. Fixed exchange rates vanished, but central bank coordination not only persisted, but expanded and intensified through less conspicuous channels. The International Monetary Fund relinquished its role in monitoring currency pegs, but gained something more potent: the authority to manage currency crises through conditional lending, thereby reshaping entire national economies. The Latin American debt crisis of the 1980s provided a clear demonstration of this newfound power. When Mexico announced in August of 1982 that it could no longer service its foreign debt, the International Monetary Fund intervened, not merely to provide emergency financing, but to impose structural adjustment programs that extended far beyond the monetary policies of the Bretton Woods era. These programs mandated the privatization of state-owned enterprises, the elimination of price controls, the reduction of trade barriers, and the reorientation of entire development strategies toward export production and debt repayment. The conditions imposed were more intrusive than anything the International Monetary Fund had demanded under Bretton Woods. Nevertheless, they operated through the same crisis paradigm, leveraging emergency circumstances to implement permanent structural changes. Following this, the Plaza Accord of September 1985 demonstrated that major central banks could still collectively manipulate currency values whenever they deemed it appropriate. Finance ministers from the United States, Japan, Germany, France, and Great Britain convened at New York's Plaza Hotel and announced coordinated intervention aimed at depreciating the dollar's value against the Japanese yen and the German Deutschmark. This maneuver proved remarkably successful, with the yen appreciating by 50% over the subsequent 2 years. Japan's subsequent lost decade of economic stagnation could be directly traced to this imposed currency appreciation, illustrating that coordinated central bank actions could reshape national economic trajectories just as effectively as the former fixed exchange rate system. The Louvre Accord followed in February of 1987. This time, the objective was to halt the dollar's decline and stabilize currencies within unofficial target ranges. Taken together, the Plaza and Louvre Accords demonstrated that freely floating currencies were, in fact, managed floats, with major central banks coordinating their actions to achieve desired exchange rate outcomes. The mechanism had shifted from maintaining formal pegs to engaging in collective intervention within supposedly free markets, but the underlying control remained. What truly endured beyond the collapse of Bretton Woods was not the specific exchange rate arrangements, but the institutional infrastructure and the established precedent for supranational monetary management operating beyond democratic accountability. The International Monetary Fund evolved from an exchange rate monitor to a crisis manager with significantly expanded authority. The Bank for International Settlements deepened its coordination role, hosting monthly meetings where central bank governors devised policies away from public scrutiny. The Group of Seven, and later the Group of 20, formalized high-level economic policy coordination. Most importantly, dollar hegemony persisted and even strengthened, entirely independent of gold convertibility. The petrodollar system, established in 1974 through agreements with Saudi Arabia and other Organization of the Petroleum Exporting Countries members, generated new structural demand for dollars by stipulating that oil transactions be denominated in U.S. currency. Nations required dollars not only for their reserves, but also for energy purchases, thus fostering a deeper dollar dependency than Bretton Woods had ever achieved. The liberalization of financial markets throughout the 1980s and 1990s created vast pools of dollar-denominated assets, making the dollar even more dominant as a reserve currency in 2025 than it had been under gold convertibility. Currently, the dollar accounts for approximately 60% of global foreign exchange reserves, a higher proportion than during much of the Bretton Woods era. The financial crisis of 2008 spurred calls for a new Bretton Woods to reform the global monetary architecture. However, what actually emerged followed the established pattern. Crisis conditions provided justification for expanded central bank coordination, which subsequently became permanent. The Federal Reserve established unprecedented dollar swap lines with other major central banks, providing virtually unlimited dollar liquidity to prevent the collapse of the global financial system. These swap lines continue to operate today, having transitioned from emergency measures to permanent infrastructure. Central banks coordinated quantitative easing programs that dramatically expanded their balance sheets, accumulating trillions of dollars. The Federal Reserve's actions, which effectively dictate global financial conditions due to the dollar's prominence, elevated the G20 from a mere technical discussion group to a forum for high-level policy alignment. This process cemented economic strategy coordination beyond the scope initially envisioned by the Bretton Woods framework. Concurrently, proposals re-emerged for the International Monetary Fund to issue special drawing rights, positioning them as a global reserve currency. These ideas echoed concepts from the original Bretton Woods negotiations concerning the establishment of an international currency independent of any single nation's authority. Crucially, none of these developments were reversed once the immediate financial pressures subsided. They became the established norm. Presently, central banks are collaboratively developing central bank digital currencies through the Bank for International Settlements. This initiative could result in a digital counterpart to the Bretton Woods system, offering even more direct oversight of financial transactions. The BIS Innovation Hub is actively testing multinational central bank digital currencies designed to enable central banks to directly clear cross-border transactions, bypassing traditional commercial banking intermediaries. This represents a modernized Bretton Woods 2.0, powered by technology rather than gold-backed pegs, embodying the same centralized management of financial power, updated for the digital era. The COVID-19 pandemic in the year 2020 sparked another surge of unprecedented coordination among central banks and a massive expansion of monetary supply, mirroring the exact trajectory set by the Bretton Woods agreements 80 years prior. Under the guise of emergency measures, trillions of dollars in new currency were created, with central banks coordinating their policy responses and acquiring government debt on a scale previously considered unimaginable just months before. The Federal Reserve's balance sheet alone ballooned by almost $5 trillion in a single year. These temporary emergency actions show no indication of being rolled back, instead adding another layer to the permanent financial infrastructure justified by the exigency of crisis. Tracing the trajectory from 1944 to the present day reveals a crucial insight. The Bretton Woods system was not fundamentally about the specific financial arrangements like dollar-gold convertibility and fixed exchange rates, which ultimately unraveled in 1971. Despite the collapse of those specific monetary mechanisms, the institutions established at Bretton Woods not only endured but significantly expanded their influence and jurisdiction. The International Monetary Fund now operates with considerably greater authority than it held under the original system. The World Bank has evolved into an extensive development apparatus, managing hundreds of billions in lending. The Bank for International Settlements now orchestrates global central bank policy through methods that were inconceivable in 1944. The dollar's dominance persisted, uncoupled from gold backing, demonstrating that Bretton Woods' true objective was never gold convertibility, but rather the institutionalization of dollar supremacy through enduring structures designed to outlast any particular financial arrangement. The gathering at the Mount Washington Hotel laid the groundwork for coordinating financial control that extends beyond national democratic processes, and this framework has only grown stronger with each subsequent crisis. The pattern repeats with striking regularity. World War II created the conditions for Bretton Woods, which in turn established a permanent infrastructure for the dollar system. The Great Depression transformed the Federal Reserve from a limited lender of last resort into an active economic manager. The crisis of 2008 broadened central bank authority to encompass quantitative easing, asset purchases, and direct market intervention. The pandemic of 2020 normalized fiscal and monetary coordination, blurring the lines between government spending and central bank money creation. Every crisis fosters the development of coordination mechanisms and institutional expansions that are never fully dismantled. Central bankers did not require Bretton Woods for post-war recovery. That was achieved through direct aid and investment via the Marshall Plan. Nor did they need it for exchange rate stability, given that the system faltered within 3 decades. Similarly, its utility for development assistance is questionable, as the World Bank's actual developmental impact remains a subject of intense debate. The true necessity of Bretton Woods lay in establishing a permanent institutional framework that would grant them coordinated dominion over international financial matters, insulated from the influence of national democratic politics. The brilliance of Bretton Woods resided in its creation of institutions and precedents that would survive the disintegration of the very systems they were ostensibly designed to uphold. The IMF outlasted fixed exchange rates. The World Bank outlasted reconstruction lending, and coordination mechanisms persisted beyond formal rules. Dollar dominance endured without gold convertibility, proving that the institutional architecture proved far more resilient than the financial arrangements it purportedly served. This underscores the actual function of international financial agreements. They are not primarily concerned with the specific exchange rate mechanisms or reserve assets they establish, but rather with forging enduring institutional frameworks for coordinating financial control that transcend national sovereignty and operate through technical expertise, effectively marginalizing democratic participation. Bretton Woods perfected this strategy, establishing institutions that would augment their authority through successive crises over the subsequent 8 decades. Understanding this pattern equips one to identify its presence in every contemporary proposal for international financial reform. When calls arise for a new Bretton Woods, for enhanced IMF powers, for coordinated central bank digital currencies, or for global financial regulation, one is witnessing the same underlying strategy. Crisis provides the impetus for institutional expansion. Technical complexity serves to exclude democratic oversight. Temporary emergency measures are transformed into permanent structures. International cooperation is employed as a euphemism for centralized control. The key takeaway is not that international coordination is inherently flawed or that financial management does not demand expertise. Rather, it is that moments of crisis facilitate power shifts that are seldom reversed, and institutional structures erected under emergency conditions tend to expand well beyond their originally stated objectives. The Bretton Woods Conference, a 3-week gathering during wartime, initiated an 80-year period of expanding monetary control through institutions that have repeatedly outlived their initial justifications. The most significant revelation from Bretton Woods is this: it was not primarily about rectifying the international financial system after World War II, but about constructing an international financial system that central banks and finance ministries could control independently of the constraints imposed by national democratic politics. The institutions, the coordination mechanisms, the dollar's dominance, and the overall management were all devised to concentrate financial authority within entities that are not accountable to any electorate and operate through specialized knowledge that ordinary citizens cannot meaningfully challenge. Once this pattern is recognized, its manifestation becomes evident in contemporary proposals for addressing future crises, irrespective of their nature. The playbook has remained consistent since 1944. Only the specific financial arrangements are updated, while the fundamental architecture of centralized control deepens and expands. This is the true accomplishment of those 730 delegates at the Mount Washington Hotel in July of 1944. While soldiers continued to fight and perish on distant battlefields, these individuals constructed the framework for financial control that shapes our economic reality today, and they engineered it to endure far beyond any specific crisis or currency arrangement. The Bretton Woods system eventually collapsed, but its underlying purpose was fulfilled and continues to operate through institutions that grow increasingly robust with each new crisis.